fucking invincible. Why do I feel that this is a myth when it comes to investing? A lot of people say with these high yield funds, and we're going to take a look at a few examples. But first, I'm going to tell you my overall thought process why I think it's a myth or it's a bunch of BS. And what most people fail to realize about these funds is that when they're giving out that high income every single month, that is not erosion because it's being given out to you. It's not disappearing. It's not going just anywhere. It's being given out to you in the form of a distribution in the form of a dividend, right? So how could it be erosion if you're getting it every single month? Don't forget, everyone, when a high yield fund, whether it's a covered call fund, a leveraged fund, whatever it is that does covered calls, doesn't do covered calls, every month that it gives out that, let's say 10 cents a month, that 10 cents is coming from the NAV, right? It's not coming from, appearing out of nowhere. So the fund makes 10 cents in that month, let's say, and it's being given out to you. It's not eroding. How could it be eroding if it's actually being given out to you, right? So when someone says NAV erosion, it doesn't make any sense to me because the NAV is consistently being given, a part of the NAV is consistently being given out to you in the form of income. What you do with that income, whether you buy more units, you would reinvest it in something else, whether you just keep it in cash and spend it to support your lifestyle, is completely up to you. But don't say it's eroding. Let me give you an example. Let's look at probably one of the most popular ones where people actually have this argument, QYLD. Okay, and I recently made a Facebook post about this. We'll go through it. So QYLD is a very high yield fund, which basically writes, first of all, it's a NASDAQ 100 index. They write at the money calls on the index on 100% of the portfolio, which means they're literally forfeiting all of the upside potential of the NASDAQ 100 index. And every month they're giving a really big distribution. You have them here. They've been doing this since 2014, and they actually added a really nice column here. And if you click here, you could actually see every month how much in percentage wise they're making with this really, really high premium. So they're giving out all the income, but every month they're making a really big premium. And the last one, let's look at the July one, 2%, a little over 2%, which means they're literally making 2% return that month. And what they do is they give out 1% of it, typically, approximately. So you see that here. The QYLD distribution is 1%. So they cap it at 1%. You could check out my recent QYLD, RYLD, XYLD explain video if you want to know more about this. But basically the fund made 2% gain because of that premium. 1% gets given out to you in the form of distribution, and the other half, or the rest, gets reinvested in the fund, increasing the NAV. So it makes 2%, that increases the NAV by 2%, and then it gives out a 1% of it as income, and the rest is reinvested. And you can actually see the monthly distributions throughout the life cycle here, throughout all the years. So why is QYLD a perfect example? Well, if we look at the post I did on QYLD in Facebook, people keep saying, and there's a million videos and YouTubers that talk crap about QYLD. They say that QYLD's NAV price or stock price just keeps eroding over time. So QYLD started, if we go to the max chart, at about $25. Right now it's at $17.52. I am filming this on August the 17th, so we're down 29%, 30 now, because it just went down a little bit more because the stock market is open, it's live. So you might be saying, look, this looks like a gradual erosion. It's not true. You cannot just look at the stock chart for anything that gives out income. So my argument is, and I posted this on May the 7th, so keep in mind these are going to be related as of these prices I'm talking about in this post relating to May 7th, not right now. So on May the 7th, approximately, QYLD's price is $17.40. NAV erosion, well, because as we saw, QYLD started at $25, but it can't be erosion because since inception, or since May 7th, as of May 7th, QYLD has given out $21.86 a share of income, right? If you add all the distributions throughout all the years, as of May here, QYLD has given out $21.86. So you can't just look at the stock chart and say 25, down to $17, my NAV is erosion. No, those monthly distributions are being given out to investors. How could it be erosion if decomposition, disappearing? It's being given out to you, so it is not erosion. So you have to factor in all those monthly distributions, and if you factor it in, you have to add whatever the stock price or the NAV is right now of QYLD, 1740 plus
In today's video, we're going to discuss how to offset the NAV erosion seen in Defiance funds around their X dates. As you know, today is the 1st of December, so we had our X date drops in Defiance funds. So I'm going to share with you how I'm offsetting that performance issue, because as you can see, we're up 9,000 for the day. And again, I'll share with you those techniques in a moment. So we earn over 150,000 per year in dividends at this channel. We're up 23% for the year, and the Nasdaq's up, well, the SP is up 19%. The Nasdaq is up 35%. We were beating the Nasdaq. We were beating everything earlier this year. We were up 50%, but the market had a pullback in the month of October, closed-end funds in particular, which is what I'm tied to mostly. And so we had a nice bounce back recently, but that wasn't because of margin, our performance fall. That was because of, again, closed-end funds and many value funds falling. So I'm still living the FIRE lifestyle here at this channel, and so can you. Email me for my e-guides at akintodd48@gmail.com if you're interested in doing the same. The FIRE lifestyle is a financially independent, retire early. The reason why I pitch my e-guides so much is because I get so many questions on these subjects, okay? I start out in YouTube with no e-guides and no Discord chat room. But as the channel grew and I got so many more questions daily, I had to make the e-guides. And then that brings me into my first point, how I'm beating the erosion in Defiance funds. First, I'm beating that with diversification, okay? So I'm beating the erosion through diversification. We got our QQQY and JEPY and even IWMY drops today because of the dividend announcement. So here's IWMY. It was up today, but it still dropped, okay? Because we were up pretty nicely in this position. Now we're down 500 in IWMY, for example, and now we're down 2,000 each in QQQY and JEPY. So we had our drops pre-market today. I'll go and even show you the chart of JEPY. So, but we're beating that again through diversification. Here's the drop on the chart, as you can see, okay? Because the X date was on the 1st today, 12/1. This is when you have to get in to the fund. You have to be in before this date to receive the dividend, which is around 50%, which is really high. Okay, so that's how I'm beating the erosion today, okay? All right, it's through diversification. Now, Cornerstone, you have to play this fund properly. It's a 4-star fund. Yes, this is where I'm getting most of my income today. I mean, my day's gains, so that's 7,000. Plus, I'm getting my income mainly from this fund. I have about 400 grand in this fund, okay? Because it's 5 stars, actually. And to all newcomers at this channel, I have to state what Cornerstone is, because first of all, that's how I'm beating the NAV erosion from Defiance. I'm beating it with diversification, and Cornerstone is the main vehicle. I'll show you the next vehicle I'm doing this with, but Cornerstone beats the indexes, as you can see here below, okay? So people who are new to this channel will come in and they'll say, how are you beating the market with Cornerstone when the chart goes sideways? Well, it's very similar to Defiance. They both erode because of their dividends. They drop on their dividend dates. So you have to drip Cornerstone in order to offset that NAV erosion. But I'm going to tell you why I don't drip Defiance, okay? Cornerstone has a special drip program. It drips its 21% dividend down at the NAV. You can toggle that yourself. You just have to learn how to play Cornerstone around its rights offering time periods, which many closed-end funds have. They have rights offerings, and that's why their stocks drop so much each year. Okay, if you need help playing Cornerstone, that's in my Volume 4 e-guide, okay? I also have a Volume 3 e-guide on how to use margin and dividends to live financially free out of your brokerage account. And that's why I am so tied up into Cornerstone, because it has 30% maintenance on top of everything. So JEPY and QQQY have 50% maintenance, but if you go to the Cornerstone snapshot, you'll see that it has 30% maintenance. So if you go to other brokers, you can get Defiance funds for lower maintenance, okay? But they don't have the special drip for Cornerstone. So this is why it takes a total approach here. there was the 30% maintenance figure for Cornerstone. So Defiance funds, you know, they have 50% maintenance at E-Trade. So that's the secret to living financially free out of my brokerage account is having these funds. First of all, you know, before we even talk about beating a NAV erosion in Defiance funds, you have to make sure that your maintenance levels are right because they're 50%. And again, you can go to another broker, but then you might not get the Cornerstone drip. So Cornerstone is the way to really outperform in the market. And then your maintenance is the way to really ensure your financial freedom, because even if you don't use margin like I use, look, I have 151,000 in margin debt. Okay, for every $1 you put into your account, you get $4 of purchasing power. Okay, so around $1 million of purchasing power is what we have here at this channel in my particular brokerage account, because I get 4 times this value. If I didn't invest this value, 456, I'd have 4 times that amount. But the reason why I have still such a large amount of purchasing power left is because my maintenance is low in Cornerstone. That's how I anchor my equity to such a, to keep my equity so high, my available draw high. This means that, because this number is what it's all about if you're new at this channel, okay, 456 is my account value, but 221 is my available withdrawal. So that means I can withstand 30% corrections overnight or in a course of a month. Okay, obviously over the course of a year, my dividends pay back my margin debt of 150,000. So my leverage goes away in about 1 year because again, my dividends are 150,000. So this number needs to be able to withstand a 30% correction, your available withdrawal, and you have to be able to withdraw out of your account freely so that you can actually pay your bills and live the FIRE lifestyle. So even if you're not using the margin debt that I'm using, you want to have low maintenance names so that this available withdrawal stays high. And again, if you need help understanding maintenance, that's in my volume 3 margin e-guide. So when you buy all my e-guides, you get free access to Discord for life and my phone number for life. Please keep that in mind. So the first way that I offset erosion in Defiance funds is through diversification with Cornerstone and small caps. Okay, if we go to OARC, you'll see that it's up 4.5% today roughly, and so is Coney. Coney was up 4%, and so these, I mean, this contributes to a lot of my day's gains. 646 in OARC, and also in Coney we made a couple $100. So this is really key to your total performance. Okay, you need to have diversification. And the Dow Jones and the Russell 2000 have been on a have had a strong move lately, while the Nasdaq has been still creeping higher. It's starting to reach highs, whereas it seems like there's more value in these small cap plays. So diversification is key here. All right. The second key that I'm using to offset erosion in Defiance funds is to just simply drip your dividends. But I'm not dripping the dividends in Defiance. Here's why. Because as you saw by that chart in Defiance, it drops by the amount of the dividend on the ex-dividend date. So this is where you would want to rebuy your shares and drip it, right? Well, for me, this is a problem because Defiance funds are the indexes. And if we go to a chart of QQQY, I already showed you this chart. So to be more accurate, let's go to a chart of QQQ, which is the underlying that it tracks. If you need more help understanding Defiance funds, go see my past videos on what they do exactly. Today's video is going to be on how to get more performance out of our Yield Max funds. Those funds have high dividends, but they tend to decay because they sell covered calls, synthetic calls, so the upside is capped in our Yield Max funds. So how can I get more performance out of those Yield Max funds? Also, there's an echo in the room because I can't be in my room. I'm in a hallway in my hotel in New York because it's so noisy outside. So forgive me for the background noise. We make over 100,000 per year in dividends, okay? And Yield Max contributes to that number significantly. We were also up over 6,500 yesterday. We're actually up 7,500, but sometimes E-Trade glitches on the weekends. Performance and value. I'll show you that we're up 22% for the year. The Dow's up only 0.3. The S&P is up 10%, and the Nasdaq's up 25%. So we're beating the S&P and we're catching up to the Nasdaq as we've been discussing over the past few videos. And today I have one trick to share with you on how to get more performance out of our Yield Max funds. We already use a large amount of margin here to get our income up to what it is. We use over 250,000 in margin, 260,000 in debt. Actually, it's not a large amount compared to my account size, which is 386. So when you can just use a portion or half of, not even half, just use 10 to 20% of your margin purchasing power, you can be safe from margin calls and still get extra income in the process. This is my equity number, and if it falls below 0, I'm in a margin call. So we have plenty of cushion there to withstand a 10 to 20% market downturn. So if you need help on how I use margin, please email me for my e-guides at aikentodd48@gmail.com. I also have e-guides on Cornerstone, which is how we also get our performance. CLM here, it has a 21% dividend, four-star fund on Morningstar. And every month my dividends are dripped here at the NAV. These $6 prices, that's the NAV price. So $6, $6, $6 for instant 24% gains. 16% gains, 20% gains. So these are all my dividends reinvested. I get $3,500 a month in dividends from each Cornerstone fund, and they reinvest at the NAV for another 21% dividend. So you compound those gains, that dividend, plus you get the capital gains of the drip, which I just showed you, those 20% lots. And then last but not least, you get days gains too on a daily basis. When the market's up, it tracks the market. So we're up 1% roughly for each Cornerstone fund on Friday, and that's $2,000 and $2,000 of my gains. So where do the other, $3,000 of gains come from? Sometimes E-Trade glitches on the weekends. It's updating numbers. So we made over 7,500 on Friday, and my net account value proves that because we're up to 386 now. And if you see my past videos, that's a substantial jump. So here's my little trick I use for the Yield Max funds. I buy Fangu because Fangu, I only buy a small amount, but I'm up 15% already in Fangu right here. And I want to have 5,000 total in it because it's a triple leverage ETN, which is very risky, but 5 times 3 is 15,000. So it's like having 15,000 of a single tech fund. We've already added other tech funds, but this is a way to get a little extra leverage, times 3 leverage. And also the good thing about Fangu is that it has the Yield Max funds in it. Look at the holdings of Fangu, the top 10 holdings. It only has 10 holdings. It has Tesla, Nvidia, Apple, Amazon. So, and a lot of these stocks are still cheap. A lot of them are way off the highs. Half the stocks in this fund, about 5 are at the highs, and about 5 are considerably off the highs. So there's room for Fangu to run higher. Plus, look at what it did on a 10-year test. It hasn't even been out for 10 years. It came out in 2018, and it still almost made $100,000 on your $10,000. So by far, blows away every tech fund I've ever come across. It's just very risky. It doesn't have a dividend, and it's 100% maintenance. So 100% maintenance, we hate at this channel because that takes up all of your equity. And as you know, when we're using margin, you want to have low maintenance names because they take up less equity. Cornerstone is a 30% maintenance fund, so it only takes up $300 of my equity when I buy $1,000 worth. If you buy Fangu $1,000 worth, it's going to take up $1,000 of your equity. So it's detrimental to your account if you have too much of any 100% maintenance name like a Fangu because you have no equity left to use for your margin purchasing power. And you don't have to use margin to get ahead in life. You can just have dividends on top of your job. But I choose margin in addition to the dividends because it's a form of a loan, but it's automatically granted to me. Every $1 you get in your account, you get $4 here. And I'm just using a fraction of that, like I said before, to get ahead. Most of the greats I know use loans to get ahead. Warren Buffett used a loan, Dan Loeb. And a lot of the greats I know use margin. Elon Musk bought Twitter through his margin. So this is how I live my life financially free. I'm traveling the world. I'm in New York right now doing some research on the commercial real estate side of things here for SLG. Stay tuned for that video. And I just live out of this available withdrawal number. My income of $100,000 per year in dividends pays back this debt in less than 3 years. It's $260. And then I'm just left with all my dividend paying assets free and clear. They're all mine, producing $100,000 per year in dividends for life. So the 386 will turn to 686 in the next 3 years just from my dividends alone, and this 261 number will go to 0. That's much better than the way credit cards work. If you pay back your balance on a credit card, you just have 0 balance. But like a house, if you pay back your loan on a house and put it back into the house, you get more equity, and that's how you really grow your account. Plus, interest on my margin rate is only 5%. So it pays me to not only be in these dividend-paying funds that have a higher rate, but also it's better than a credit card. because credit cards charge you exorbitant interest rates. So this is how I'm living financially free, traveling the world. Also, dividends provide qualifying income to the banks, which allows you to get loans. I just got a loan for a new car last week before I came up here. So that's proof that my dividends work as qualifying income to open up your world. You can travel, you can buy a house, buy a car, do whatever, withdraw cash, all from the dividends. So this is how you get ahead in life without having a 9 to 5. Or if you have the 9 to 5, it just makes you even stronger. And if you do a 9 to 5 plus dividends plus a little bit of margin, you're going to be getting way ahead of my account too, that's for sure. So anyway, I hope you enjoyed the video. I use Fangu as my little trick to get more performance out of the YieldMax fund, since Fangu is a large mover and it has a lot of the YieldMax names in it. I don't suggest buying a bunch of Fangu. I'm just saying I have a very small amount, and all these numbers combined are what gives me my days gain performances as well, not just my yearly dividends. You need days gains because you don't want to have just large dividends and your account decays and goes to zero and you never get ahead. You want to also have best of both worlds, dividends and capital gains. So I hope you enjoyed the video. Leave questions in the comment section below if you have any other ideas on how to play the YieldMax funds and maximize our income there and our performance. And again, if you need help on my e-guides for margin or cornerstone, just email me at aikentod48@gmail.com. Thanks.
When I first started this channel back in 2020, I had two main goals in mind. I wanted to discuss and analyze all of the major high-yielding investment types that exist, since I am primarily an income investor. But I also wanted to every now and then share my own journey as someone who's building up a massive income stream through dividends, which is likely what you're in the process of doing. And throughout the years, we've seen a lot of new investment types launch that are designed specifically to offer exceptionally high dividend yields, which is something that's really encouraging for investors like us. But one of these new investment types that's launched more recently are these synthetic covered call funds. And this is a strategy that I've only seen utilized by a company called YieldMax. These synthetic covered call funds offer the highest dividend yields out of anything you can possibly find on any stock exchange currently. And I'm often asked by people, both here on YouTube as well as over on our Patreon, why don't I personally own any of these YieldMax funds if I really am an income investor that's focused on high income for my portfolio? Today, there are entire YouTube channels that exist that are dedicated to covering all of these YieldMax ETFs that are run by these people who are investing large amounts of money into these funds. And the truth is, all of these people have the exact same goal as I do, and potentially you as well. We're all looking to earn huge amounts of passive income through our investment portfolios. Our main objective is to make an income stream that we can use to either live off dividends much earlier in life or as a means of supplementing our income during retirement. Not only that, but I'm also a fan of covered call funds. In just the last year or two, we've been seeing a lot more variety when it comes to these ETFs. And in my opinion, many of these newer covered call funds coming out are better than the older ones. And in fact, there are a few people over on our Patreon who like holding these YieldMax ETFs. But I've discussed in the past a couple reasons why I haven't had any interest in holding any of these YieldMax ETFs myself, despite their insanely high yields. One of the first reasons why is that these YieldMax funds are not well diversified. Almost every other ETF out there that uses some form of covered call strategy writes covered calls on an entire index. For example, QYLD writes covered calls on the NASDAQ 100, which exposes itself to 100 different companies. SPY writes covered calls on the S&P 500, which is exposed to 500 different companies. And even actively managed covered call funds like JEPQ, which don't follow an index, are still very well diversified. Almost all of the YieldMax funds are exposed to just one company, with the exception of Treasuries, which is part of their option strategy. TSLY is only exposed to Tesla, NVDY is only exposed to Nvidia, and FBY is only exposed to Meta, and so on. Because safety is a really important part of my income portfolio, I don't like the idea of holding a fund that only contains one company. Literally over 90% of every position in my income portfolio offers some kind of diversification, even the REITs and the BDCs I hold. Real estate investment trusts at the end of the day are just pools of hundreds or thousands of real estate properties. BDCs are basically funds that hold corporate debt issued to small and medium-sized companies. But these YieldMax funds are significantly less diversified, which makes them riskier investments. To their credit, YieldMax has recently started offering diversified funds that hold several of their own ETFs. YMAX, for instance, is one of their fund of funds that holds several of their own ETFs, which in my opinion is a better option. But even these funds aren't well diversified enough for me. I'm sometimes asked, even though I personally don't hold any YieldMax funds myself, what would I consider to be their best ETF in their lineup? And if I absolutely had to choose one, I would have to go with YMAX for the diversification that it does offer. But YMAX still isn't well diversified enough as it only holds 20 companies. My second reason for not holding any YieldMax funds is that I'm not confident they're suitable long-term investments. This really boils down to the main strategy that these synthetic covered calls employ. There's a big difference between regular covered call funds, which I like, and synthetic covered call funds. In YieldMax's own words, a traditional covered call strategy is an investment strategy where an investor sells a call option on an underlying security it owns. A synthetic covered call strategy is similar to a traditional covered call strategy in that the investor sells a call option that is based on the value of the underlying security. However, in a synthetic covered call strategy, the investor does not own the underlying security, but rather seeks to synthetically replicate 100% of the price movements of the underlying security through the use of various investment instruments. All covered call ETFs see limited upside when the underlying security is performing well. That's just the nature of these investments. But what we've seen so far with these synthetic covered call strategies is that when the underlying security is doing really good, these YieldMax funds appear to be doing worse from a share price perspective than other covered call funds that exist. What this results in is far worse times for the YieldMax ETFs. A good example of this would be TSLY. If we look at the performance of Tesla over the last year, we can see it's down 10.9%. It's no secret this stock has been doing poorly over the last year. But if we look at TSLY, we can see this ETF is down 50% over the exact same time span. Because of this, the amount of dividends this ETF pays has dropped significantly since its inception. Originally paying around $2 2 years ago, its last dividend was for only 69 cents. I would just like to ask a genuine question to everyone who owns TSLY. If it's your goal to live off dividends from this ETF, how do you expect to plan a budget around this kind of income? Imagine Tesla takes off in the same way Nvidia has. Obviously, every stock has good seasons and bad seasons. So assuming the underlying stock your YieldMax fund invests in is in a prolonged bad season, how can you budget your retirement with income that changes this much? If the goal is to live off dividends, you should be looking for income that's much steadier than this. Now, there's no denying that you can make really good returns with YieldMax funds when times are really good. NVDY, which is YieldMax's Nvidia fund, has done exceptionally well since its launch. This is obviously because of the AI boom we've been seeing with Nvidia. But the question we need to ask is, what's going to happen to NVDY when the AI craze starts slowing down for Nvidia, which is going to happen? Nvidia's stock won't return 180% every year for infinity. We've already seen TSLY go down in share price so much that they had to do a reverse stock split. It could be even worse for NVDY if there's a massive share price decline of their stock. And I get that sometimes, even with an investment that has seen a significant share price decline over time, it can still be a profitable investment if the dividends are massive. I've shown this before. CLM is an example of this. Despite the share price of this high-yielding closed-end fund falling over 95% since its IPO, because of the massive dividends, it's still been a profitable investment. It hasn't offered amazing returns by any means, but the fact that you'd be looking at a gain at all from a fund that's collapsed 95% is incredible. But this all still depends on if you're reinvesting the dividends you receive. If you weren't reinvesting all of the dividends, then your returns would be significantly less than what you're looking at right now. With that being said, so far nothing YieldMax has offered in terms of investments I believe have been suitable for an early retirement or living off of in retirement. I think that all income investors should be looking for opportunities that yield a maximum of around 15%, depending on the investment type or if it's trading at a massive discount. Almost always, anything more than this will involve a significant amount of risk. If you're living off dividends, you want to make sure that they don't change too drastically from month to month or over time. I know it seems like an early retirement is well within reach with these ETFs, but the issue with some of them is that you won't stay retired if your income drops this much. On this channel, I cover a wide range of high-yielding investment types, including REITs, BDCs, covered call funds, closed-end funds, MLPs, and others. These investments are all designed to offer high yields that are great options for aiming to retire early or live off of in retirement. They don't yield as much as synthetic covered call funds, but the income they do provide is still very high and you won't see huge dividend cuts or significant share price declines. You can still create a really good income stream with safer investments that yield high. Let me know your thoughts in the comments below, but with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other
Now, as you can see by my long-term dividend paying portfolio, I'm by no means an ultra high yield income focused investor that focuses only on buying into dividend paying stocks and ETFs that offer a massive yield from day one. Now, this is pretty apparent because you see things like my 2,700 shares of Realty Income stock, which yield around 4 or 5%, or my 1,000 shares of Apple stock, which offer a yield on cost of around 1%. But over time, as more and more of these awesome, super interesting alternative investments that have been coming out like crazy as of recent are starting to spark some interest for me personally, and I've been adding some of these to my portfolio as of recently. But in this video, we're going to go through, I'm going to share with you an ultra high yielding ETF that you probably haven't heard about as of yet, that yields around 25% and has offered a positive total return with zero NAV decay. This ETF has a super interesting strategy, and I promise you're going to want to see what this ETF has to offer. So if you want to go through the 25% plus yielding, zero NAV decay ETF with me, make sure to stick around, drop a like down below, and let's get right into it. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the markets. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. So the ETF that I'm talking about, the ETF that we're going through in this video, is ticker symbol ZIVB, or the -1x short VIX midterm futures strategy ETF, which currently has a distribution rate of around 25-26% and a 30-day SEC yield of around 1.44%. Now, this ETF came across my radar just as of recently, and I looked into some of the performance and what this ETF really does, how it works, and I'm honestly sort of hooked. As long as the market trades sideways and or up a little bit, this ETF is set to do amazing. But to dig a little bit deeper into how this ETF works and to get us all up to speed, it says right here the fund and index description, now with monthly distributions. It says the -1x short VIX midterm future strategy ETF, ticker symbol ZIVB, aims to provide daily investment results that correspond to the daily performance of the S&P 500 VIX midterm futures inverse daily index before fees and expenses. It may be used to express a medium-term view on declining implied equity volatility. And to make this very easy for you guys to understand exactly how ZIVB works, it's very similar to that of SVOL or SVOL, the Simplified Volatility Premium ETF, but instead of only having exposure to around 0.2x to 0.3x inverse, ZIVB offers entire exposure to basically the inverse of the VIX. Now, some more facts about ZIVB is this ETF has been trading since April 19th of 2023, so there isn't all that much data to go off of, but there's enough data to see if or if not this ETF has performed either good or bad, at least historically. The expense ratio is 1.35%, so it's up there as far as expense ratio goes, although with these more actively managed income-focused style ETFs like QDTE, SVOL, like the others, these are going to have pretty expensive expense ratios. Now, before I go through and share with you exactly the performance of this ETF as far as price performance, looking at some of the distributions historically, this ETF has been paying around 48.5 cents every single month for a while now. And spoiler alert, keep in mind this ETF does not cost all that much, which I'm sure you sort of got the picture because a 25% distribution rate is massive. So at this point, you might be saying to yourself, okay, another short VIX ETF strategy that pays massive distributions every single month, around 25% distribution rate as of right now, and has been doing so consistently. But what about NAV decay? Has this ETF lost value since inception? This is the craziest part of my opinion. Since around April 2023, since this ETF started trading, ZIVB is up 31.92%. And what's even crazier is that just a few months back, this ETF was up even more than that. This ETF that pays a 25% distribution that shorts the VIX, so basically as long as the volatility throughout the market stays calm, doesn't spike up like we saw just a few weeks back, as long as the VIX continues to decay and as long as the market stays calm, ticker symbols like ZIVB will do just fine. Now, just to back up for a second, ZIVB is down around 12% more or less year to date, so it has not been having a great year as far as price return goes year to date. Now, keep in mind, if you use the distributions and if you look at total return, this is going to be a different story. But just 1 second here, over the 1 year time frame, Holders that have held onto ZIVB are basically more or less flat, down around 2.5%, but again, with a 25% distribution rate, they've net gained around 22-23%, which is massive. Now, like I said a minute ago, on the max time frame, which is really what matters, investors that bought into this one just over a year ago are actually up around 32%, and this is not even including dividends. Not even including those juicy 48-cent dividends that have been paid now consistently ever since around January of 2024. Since then, this ETF has been paying around 48.5 cents in distributions every single month on time, which is massive. But like I said a second ago, these short VIX ETFs like SVOL, like ZIVB, these ETFs are going to do well when the VIX trades down primarily because, of course, it's shorting the VIX. It's basically hoping that the volatility index will continue to decay like we've seen at least historically quite often. But during times of the market like we saw this as of recently where the VIX spikes up like crazy, these ETFs do pose a massive risk because, of course, if you're shorting something that's going to be rocketing up in price, that can definitely be dangerous. But if you believe like I do and like a lot of other investors do, that generally speaking, the volatility index is probably going to remain pretty calm unless we have some sort of black swan event, I think the VIX is going to remain at bay and or trade down from here ongoingly. And at least I'm talking about generally speaking for the most part. But here's maybe the craziest thing of all when it comes to ZIVB, at least over this time frame, and keep in mind anything can happen. These sort of ETFs especially have a high degree of risk. These ETFs are not basic index funds, and these are not ETFs that have that much of a track record of time even trading. We're talking 1.3 years. But just to be fair, over the last 1.3 years, as far as ZIVB's performance goes, growth of $10,000 over time with dividends reinvested along the way, when it comes to ZIVB, an investor would have had a total return of 54.88% over the last 1.3 years, or an average annual total return of 37.28%. Now, as far as dividend investing goes, there's very few investments out there that I've seen that have really returned these sort of numbers in this certain time frame. And I sort of hate to do this, no disrespect to SPY or the S&P 500, and of course this is comparing apples to oranges, but just to be fair, over the same time frame, ZIVB has returned around 55%, where SPY has returned around 36%. Now don't get me wrong, SPY has still returned a massive amount of returns during this time frame, but still, to be fair, ZIVB has outperformed the S&P on this time frame, which at least in this scenario speaks volumes. Now, because I personally do think that the VIX, the volatility index, is going to trade sideways and down over time, because that's my opinion, I am, as of right now, investing pretty heavily into things like SVOL, and I've been starting to buy some more shares of ZIVB just as of recently. But that being said, this would still always 100,000% be an alternative small position in my overall portfolio just because of my specific risk tolerance. But for those investors out there that are seeking massive income basically from day one, we're talking around 48.5 cents, at least is what we've seen over the past few months, and also want to buy into an ETF that has zero NAV erosion, at least as of so far. And if you believe that the VIX is going to trade down / sideways over time, ZIVB might be an ETF that you want to look into. Now, lastly, but most importantly, I want to hear from you guys down below. When it comes to higher yield and income focused ETFs in the range of around 25% distribution rate, what are some of your favorite names across the market as of right now? Drop some ticker symbols in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.
In this video, we're going to take a look at FEPI, which is the Rexfang and Innovation Equity Premium Income ETF. I've gotten a lot of requests to go over this fund, and I see a lot of praise for it here on YouTube and other websites like Seeking Alpha. One person even described it as the new cornerstone of income ETFs, which is quite the praise for it. And that's despite the fact this thing has only been around for less than 1 year at this point. The biggest appeal of this ETF is the extremely high yield, which is currently at 25.2% as of the making of this video, and it also pays monthly distributions. So let's take a look at this ETF and see if it's worth all this hype it's been getting. Their funds page oddly doesn't have a lot of useful information on its strategy, so we'll have to dig a little deeper. According to its prospectus, it says that FEPI is an actively managed ETF that seeks current income first while maintaining the opportunity for share price growth. The securities in this ETF are a part of the Solactive FANG Innovation Index. I've never heard of this index, so I did some research and this is what I found. It says the Solactive FANG Innovation Index includes 15 highly liquid stocks that are focused on building tomorrow's technology today. The index is comprised of 8 core components, which includes Apple, Amazon, Meta, Alphabet, Microsoft, Netflix, Nvidia, and Tesla. It also holds the 7 top traded names across the following fact sheet industries, which you can see include a lot of potential sectors. So ultimately, this index will only hold 15 companies at one time, and you can see the others that haven't been mentioned yet include Palo Alto Networks, Adobe, AMD, Salesforce, Broadcom, Intel, and Micron Technology. Apparently, this index has been around since 2014, and you can see this index has crushed both the Nasdaq 100 and the S&P 500 over the course of its existence, so that's definitely encouraging. To have a covered call fund use an index like this that's seen these kind of share price returns gives you hope that we'll not only see good share price appreciation, but potential dividend growth. There's a couple things that I think investors need to take note of though before considering FEPI as a potential cornerstone investment if you are seeking high current income. If you know me, you'll know that I like diversification. 15 holdings just isn't enough to make me feel comfortable to make an investment like FEPI a cornerstone of my portfolio. It's also going to result in this ETF being more volatile in share price than much larger indexes, like the Nasdaq 100. But that doesn't ultimately mean that it's not worth considering for at least some space in your portfolio. Second, this index has never gone through a prolonged tech bubble. In the early 2000s, we of course had the dot-com bubble burst, and as a result, the tech-heavy Nasdaq 100 plummeted in share price and it didn't fully recover for more than 14 years. Given how this is a covered call fund and upside is capped to a certain degree, I would hate to see how FEPI would do during another large burst like this. However, this is going to depend on you personally and what you believe about the sector. You might believe that tech still has a tremendous amount of upside potential still, or you might believe that tech is very overvalued right now, which would make you think twice before considering an ETF like this. What I wanted to know is how exactly this index picks the securities that it does and what percentages they allocate to each holding. They have a guideline document on this index's website which provides more information. It says all 15 positions must have a market cap of at least $10 billion to be considered. That appears to include their core holdings, which I guess never change. Unless I'm not reading this correctly, all 8 of these positions will apparently never lose the index unless they fall under the $10 billion in market cap. The next step involves them taking the top 30 ranked stocks by market cap and picking the top ones based on their 12-month average daily value traded. It says the top stocks are selected for the final index, starting with the highest ranked security until the final number of 15 stocks is reached. In terms of weighing each component, it says that each selection day and review day, each index component is assigned an equal weight. The index is rebalanced monthly and reconstitutes quarterly in March, June, September, and December. So now that we know how it selects each holding, let's take a closer look at this ETF strategy. This fund doesn't use a synthetic covered call strategy like YieldMax or Roundhill Investments ETFs, but rather a more traditional covered call strategy. It says, the fund strategy is to create long exposure to the index by purchasing and rebalancing all of the stocks in the index and to generate income by selling call options on the stocks included in the index. The fund seeks to generate